So these are three of the obvious examples that are making it challenging. There's also a lot of information about people who are joining hospitals, but quite frankly, I believe that the independent pediatric practice is still very strong. You just look around the room. I mean, at lunch today, there was a lot of people in there. And this is a small microcosm and a good sampling of what's happening in the United States. Many practices continue to do well. Some we're hoping they do better, but independent practices are still very strong. And the reason they're strong is because they've come together, and the highly successful practices tend to fall into this matrix. They have a very strong practice culture. They have a very clear partnership agreement. They have a good understanding about the financial and the practice valuation aspect, and their compensation is very adequately explained, and it works within the practice culture. And so this is what you might want to think about: where do you fit in? Do you have a strong culture or a weak culture? Is your compensation model, is it, hey, we're here with it recognizing that it's a true marriage where we're sharing some of the profits, or is it a eat what you kill model? And so, not making any judgment, but that's reflective of the culture. So those are all the things that need to be taken into consideration as you think about your practice culture. When we're called in to work with a practice and they say, we need you to do evaluation for us, first I say, you can get the spreadsheet, you can get the video, you can figure it out yourself, but I'm happy to help. And the first thing I want to learn is what's going on with the practice culture. Because what works for you may not work for you, but will work for you. And so we will try to be sensitive to that and what the practice culture is and what the impact is, not only on your earning, but your future succession plan. Imagine, if you will, you had a railroad track. And that railroad track extended for 400 miles. And at spot number 1, they are at 100% aligned. But for every 30 feet, it closes in or diverges by 1 degree. Over time, those rails are going to get wider or narrower, but the impact is still the same. You're going to derail the train. And so that's why I like to take this moment to talk about the importance of 100% alignment among the partners and the management team within your practice. If you are not 100% aligned, your train will derail at some point. You may have to pull over into a train station and retool some things to keep going, but you're going to constantly be pulling over instead of moving forward in the direction to provide a medical home for children. Some of the other things is the ideal of building a viable medical home that you're proud of for the patient in your community. Setting reasonable expectations of not only the employees, but the partners as well, and holding people accountable. These are some of the other attributes of a successful practice. Now, why are we talking about this? Because it all correlates to succession planning. You only want people who are owners or partners in your practice who are 100% aligned with the commitment of what makes that practice so successful. As you think about your strategic plan and your succession planning, you need to think, are we aligned financially, operationally, or do I have one provider who's doing things their way and another provider doing another? That gets to be a source of contention at times. But those are the types of things you need to think about as you're moving your practice forward, because it has a direct implication on your succession planning. As you think about your succession plan, it's not just you and your relationship with your partners, but it's also your family. Your families are impacted by this. Your commitment to the practice takes away from family time. You need to make sure that you recognize the fact that you are going into another marriage with unrelated individuals, and you are joined at the hip financially and operationally and committed to the success of the practice. So, if you think about your practice and your future plan, you need to be thinking about what does that exit strategy look like for everyone. I hate to be the bearer of bad news, but in 50 years, none of us are going to be here. Okay? The reality is that at some point in the future, every single partner will have to divest their interest. And so we need to plan for that. We need to plan for that eventuality and what's yet to come. And part of this is, what are your goals? What are your goals within your own practice, and how does that align with your partner? Those are the things you need to be thinking about as you're thinking about through your succession plan. A big part of your succession plan and valuation is looking at the owner and partner compensation. In an ideal scenario, we're going to have a base salary for every partner or owner based on the number of days they work per week. We're going to have a productivity component. We're going to have how do we handle the profit from the vaccine? How do we handle the profit from the employee providers? These are the four major areas as you look at your total compensation, which has a direct impact on two things. First, the valuation, and second, the appeal to a younger physician one day becoming a partner. So all of this has a direct impact on your ability to identify and entice someone to become a owner or a partner in the future within your practice. There are, for the owners in a practice, you have your base salary, you have individual productivity, you're making money off the employed providers, you're making money off your vaccine, you have managerial duties, you have labs and ancillaries, incentive payments, extender oversight. These are all the sources of revenue that a partner or owner gets benefit of. An employee provider is going to be limited to their earnings, which is going to be a base salary, and hopefully a production incentive. I'm a big fan of production incentives, even for employee providers. So many times, practices don't necessarily break it down like this. They have their own method that brings it all in together. But these are the things that you're really bringing in together in whatever type of compensation you have for your partners and so forth. So, when do you need a new partner? Let's start with the basics. I'm a solo practitioner. I'm doing everything myself. I'm growing. I need some help managing and running the practice. I need a partner to help me tend to the administrative duties, sharing the workload. That's an obvious one. The second one is to potentially mitigate some risk. I'm thinking about opening a new practice location. So I can go out and spend $400,000 on a build out on a lease and commit to a 10-year lease, or I can bring in a partner to help share that risk and improve the odds that I can be successful. I may not want to fund that entirely, and so what I may do is work out an arrangement in the need for capital for that additional location. I'm willing to bring in a partner. They're going to make a financial contribution that helps to go towards that expansion. And then the most obvious is when someone leaves. I'm thinking of retiring in 2 years. I want someone to come in as a partner so that I can liquidate my financial position within the practice. This probably accounts for 99% of the reason we're thinking about a succession plan. But at the end of the day, we boil it down to the 4 Ds. We have disability, death, divorce, and divestiture. Someone becomes disabled, they can't continue to practice. It's probably best that we part ways and liquidate their position. Obviously, in the event of a passing of a partner or a shareholder, we need to divest their interest and pay the surviving family or the estate. In my father's situation, because we knew the value for Dr. Calhoun and the way their process was set up, they knew how much life insurance to carry on everybody. So eventually, after a certain period of time, the children's clinic, my dad's office, took the proceeds from the life insurance and simply forwarded it to my mother. And so because they knew how the value was going to be determined, and because they knew the formula, they knew how much life insurance to get. And that's how you better plan for these unanticipated things. For divorce, I've seen many scenarios with practices where people get divorced and the soon-to-be ex-spouse is thinking this practice is worth $1 million, but in fact it's not. So that's why you need a good succession plan, but more importantly, a good valuation formula. And we'll talk a little bit more about that. And then overall general divestiture. I don't like it here in where I live. I want to move to Wyoming or whatever. They just simply want to move on to other places. What you want to avoid when you're thinking about your succession plan is you don't want to be forced with the two worst options, which is to shut down or sell to a hospital. Those are really the two worst options you can consider. And so that's what a good successful plan, as you think, is hoping to avoid. The reality is that if you are in, Baton Rouge, Louisiana, and you have your own practice, it's going to be really hard for you to convince someone from Los Angeles, California to buy your practice or become a partner in Baton Rouge, Louisiana. There's a geographical constraint. The more obvious constraint is that because of corporate practice of medicine, only physicians in Louisiana can purchase physician practices. So the point I'm trying to make is it's not like a Jiffy Lube. Anybody can open a Jiffy Lube, but when it comes to medical practices, you really have a very limited number of qualified buyers, legally and geographically. And that means that there's limited interest. When you're thinking about the valuation, time and time again, it has come up where we'll have two practices within 2 miles of each other, around the same size number of providers, but their valuations are way different. It's based on payer mix, it's based on their overhead, it's based on how they do things, really driven by the culture. So there are really no two practices alike. It is very different. We can try to normalize some things, but those are the things that you need to think about. So what are your exit, what are your options when you're thinking about your succession plan? The most obvious is an internal option, what I call an internal buyout. So Dr. Hart and I have been partners. We have Dr. Betancourt been working as an employee provider for 3 years. Dr. Betancourt is going to buy into the practice. That's an internal buy-in or buyout. Okay? That's when we have someone we know their value, they align culturally, and that's the person we want to give the opportunity to one day be an owner within the practice. The reality is Dr. Betancourt, in the example that I'm playing with, is in her mid-30s. She's still paying off med school debt. She's got a couple of young kids at home. She's thinking about how to pay for them to go to college. And the idea of springing a $300,000 buy-in is rather scary because she bought a house that she probably shouldn't have bought. So that is really the more consistent thing, is that in order for practices to have their owners liquidate their financial position, we're talking about big multi-$100,000 numbers in the majority of the cases, because you are building strong businesses based on relationship that you have built with your patients. And so this is the challenge that we run into. And I'll show you how you can get through that, but I'll preface this by saying, if I'm an employed physician making $200,000 a year, and I can make $300,000 simply by being a partner, make another $100,000 a year, if the buy-in $300,000, I'm making a 33% return on my investment. It's a slam dunk. But for Dr. Betancourt, that's $300,000. That's a lot of money. And so that's where you have to have time. But if you plan far enough ahead, and there's a method to the madness, if you will, you can more conventionally make the case and make it enticing for people to want to take over as an owner within the practice. So how do we determine those values? Looking at going back to my Finance 101 days in college in New Orleans, probably not paying as much attention as I should have, there were 3 methods. There's an income approach, where we're doing a financial analysis of your income and looking at the finances. We look at your assets. Yeah, we look primarily driven by your balance sheet. Assets and liabilities, what you own versus what you owe. And then the last is the market approach. What are comparable sales? The best example is if you're going to buy a house. find a similar house, similar age, square footage, and extrapolate the number. But these make up probably 90% of the valuation method. There are some variations and deviations of those three global categories. And we're not going to go into all of them in detail. This is more for a reference, but there's a discounted cash flow method. And say, look, this business or this practice is expected to spin off this amount of cash per year. We can do some math and come up with a value. We can look at a multiple of earnings, and we're going to dive into the multiple of earnings in a little bit. But basically, we'll dive into that in a little bit. Asset-based approach, like I mentioned before, this is really popular with the hospital. The hospitals, because the federal stark laws have limitations, they can't just pay you a bunch of money. So back in the 1990s, there was a big buying spree where hospitals were buying family practices and internal medicine doctors so they could get those referrals. Subsequent to that, there came federal stark laws. And so there's very limited financial opportunity. There's no windfall like there used to be back in the 1990s because of the asset-based approach. So if a hospital is interested in purchasing your practice, they're going to look at your assets, your liability, and then maybe give you a per chart or per patient amount, but it really varies by market. Market comparison, this is where, similar to buying and selling a house that I mentioned, it's so many square feet, a rate per square foot. That's really hard to do in a service-oriented business. And then sometimes you just got to pull out the thumb and say, that looks about right, okay? It's not a perfect science, okay? And the rule of thumb really becomes important when you think about the culture of your practice. What is important to your practice? And that's when sometimes I just pull out my thumb and say, based on what I'm hearing, this is about where we're at. And I know that's not the answer a lot of math or science-based people want to hear, but it happens often. So what are we trying to do when we look at evaluation of the practice? Number one, we want to be objective, okay? Based on the circumstances, what is fair? We want to have a concrete formula that is used every single year. I may be jumping ahead of myself, and I may repeat this in a few minutes, but I'll go ahead and say it now. In my father's practice, every April, they would run the value on a preset formula as of December 31st of the last year. Anything that happens in the subsequent year is subject to that valuation. So let me explain that. So in April of 2025, anyone want to guess why April is a good month to look at your finances as of the end of the year? Because you've been filing your tax returns, okay? Your books are the cleanest they will ever be on December 31st because your accountant's doing adjusting entries, right? So in the children's clinic situation, in April, they run the calculation as of December 31st on a predetermined formula. Anything that happens in 2026 is subject to the value, in 2025 is subject to the value as of December 31st, 2024. Does that make sense? Okay. What are we doing when we do that? We're eliminating uncertainty. When there's uncertainty, there's opportunity for hurt feelings and resentment. And that's what a succession plan is trying to avoid. We're setting reasonable expectations and holding people accountable. The reasonable expectation is that when I retire in 2026, it will be as of the value at the end of 2025. Now, I want to hold my partners accountable. Vice versa, if 2025 ends up being a bad year, that's okay. It's going to go up and down year to year. But this is the objective of having a strong valuation program within your practice so you can eliminate the uncertainty, because it's a lot easier to have this conversation before the need arises. So what is a fair price? I think a fair price is what someone's willing to pay and what someone's willing to take. My cup of coffee. Anybody want to buy it for $5? No. Is it worth a nickel? Maybe. It's what two people agree to. And it's the same thing here. What works within your culture and a commitment to the legacy of your practice? What works is what someone's willing to take and what someone's willing to pay. We can summarize this hour together on this one sheet for an internal buy-in and buy-out. I had my nemesis in high school was my algebra teacher, Sister Monica. I went to a Catholic school. And her and I did not get along, but I have a lot of respect for it. But she always said, show your math. And so that's what we do. And if you lose the slide or you can't find it or whatever, this is also available on our website at pediatricsupport.com. You can find it and you can do this math yourself. And we're going to dive into the details of what we're looking at, but this is what we do on a regular basis. And because you're already paying for Chip and Alex and Tim and all those people, there's nothing wrong with asking, hey, Chip, take a look at this because you're already paying for him to do it through your services with PCC. But here's the math. This whole presentation is summarized right here. We have our earning, we have a small multiple, we have our assets and liabilities, and here, this is what we feel that the value of the practice is for this set of numbers. We're going to dive into more detail. So let's talk about hospitals for a few minutes. How many of you have strong hospital networks in your area buying practices? Okay. There are limitations because of the aforementioned Stark laws, but they're just not as attractive as they used to be. Hospitals, to me, are the last option short of turning off the light. But it is there, and it can vary wildly depending on the market. Anybody from Atlanta? No? Children's Healthcare of Atlanta just recently went into working with community practices to keep them open. It really varies by market. Anybody from Denver? That's not really a strong option unless you go with HCA. So it's going to vary wildly by the market that you're in as a potential option. But the thing that I want to drill in is that the hospital is also eliminated. It's severely reduced by a concept called private inurement in order to keep their tax exempt status, and also Medicaid fraud and abuse. It cannot be seen as an inducement for referrals. That's why they can't pay these big amounts of money. They can't use what we call downstream revenue in determining how much they're willing to pay. But these are some of the issues that I just bring up for you to keep in mind as you think about your succession plan. If you have a partner who said, we'll just sell to the hospital, it may not be that appealing. The purchase price is going to be asset driven. And really what the hospitals are bringing to the table is not an upfront payment. What they're bringing to the table are better payer contract rates. And so the pitch usually goes like this. You come join our practice, you're going to fall onto our negotiated rate, and we're going to be spinning off a lot more money. I can pay you more over the next 5, 10, 15 years. That's where the benefit works. So if you're older and closer to retirement, it's definitely not appealing because you don't have a long enough runway. But if you're a young partner and you're looking at another 10 or 15 year career, it could make a lot of sense in what that future compensation looks like, whether it's an RVU model or a percent of revenue. Most of the time it's going to be an RVU model. So that has some appeal to younger partners because we can say over the next 10 years, this is how much I'm going to make more because of the higher rate, because they're just much more successful in negotiating rate than independent pediatric practices. And that's another whole conversation. You can also think about your building lease. How many of you own or have some private interest in the building that you are currently practicing in? And so one of the appeals of the hospital is you really can't ask for a better tenant financially, and so there's some appeal there. So it's just worth mentioning what they're doing. This is some reading put together by a law firm. They talk about compliance issues. I could probably talk for 4 hours about hospital arrangements, but this might be interesting reading. The other thing about whether or not you want to sell to a competitor. Are you a smaller practice, maybe looking to sell to a larger practice in town? I'm reminded of thinking back on my father's practice. There was a practice across the lake, Lake Charles, or if we say across the bridge. And this practice across the bridge had in the town, they had a pediatrician. And the pediatrician there had a son my age, and we ended up going to high school together. And so I knew Bert, and we became friends over the years. Bert became a pediatrician as well. Where I'm going with this is, just because you have competitors in the market doesn't mean that if you're committed to the same mission, you don't have to be competitors. But there's nothing wrong with what's been coined recently as a worthy rival. Right? Anyone ever heard the phrase worthy rival? Google it, it's worth mentioning. And within your own community, I would encourage you to think about other pediatric practices, not as competitors, but as worthy rivals to help bring out the best and everyone step up their game. Just something to think about. But the point is that there may be competitors within your market who are interested in picking up your patient base. One of the most common overlooked things when I hear about an individual, a small practice closing or whatever, who's going to tend to the medical records? There's a long period of time you got to get those medical records. So there may be some appeal of a larger practice or another practice in town committed to fulfilling that obligation for you in exchange for a potential referral. So again, what's it worth? What one is willing to take and another is willing to pay. So explore those options if you need to. Anybody here from the Austin market? All right. In Austin, there's a large MSO, management service organization. They're in the business of quasi-ownership of different practices and so forth. This offers a model in select markets. There may be an organization interested in picking up or acquiring your practice. And it's very similar to, they'll do a financial analysis, and they may be able to, they get pretty creative in what that ownership structure is. But really, the way this works is I own my practice, I have a certain amount of value, and I essentially get equity in this new parent company that owns multiple practices. So there are no dollars changing hands, but it is equity position. And this has some appeal, because when the time comes for me to retire, other practices may be willing to liquidate my financial position within my own practice. The nice thing about the MSO is that you get them access to higher rates because they are more effective in negotiating than small independent practices, but you are giving up equity within your own practice. Who would have thought that somebody would be in Vermont, let alone a PCC conference talking about private equity? But the reality is private equity is on the scene. And as full disclosure, we have represented practices in transactions to private equity firms because they had no succession plan. We've represented over a dozen practices in the last 18 months in transaction. And in every single one of them, it wasn't about the money. It was simply the fact that there was no one who was interested in becoming a partner within that practice. There was no viable path forward. And so based on that experience, we have seen a proliferation of private equity activities across the United States. There are some hotbeds of activity, but it is here, and there are options depending on what market you're in. If you're in Oklahoma, there's not a lot. If you're in Wyoming, Idaho, small population states, there's not as much appeal. But if you're in populated states, there are a lot of options. So before we get to the valuation method, let's kind of just touch on this briefly. There's a lot of activity, there's a lot of interest in pediatrics. There's a very long story as to why private equity is interested in pediatrics. But the crux of it is they recognize that over 50% of children in the United States are covered by Medicaid and CHIP. And so where private equity sees an opportunity is to get into states with high percentages of Medicaid, and the goal, the holy grail, if you will, is to do at-risk capitated contracts with the state. And organizations who have done that before have been wildly financially successful in that effort. And that's what they're trying to emulate. And so there are some concerns, there is a concern about the reputation of private equity. Personally, I don't really like this option because they're focused heavily on profit. However, there are circumstances where they do bring to the table a lot of cash to expand and to ensure the medical home is still there. And in every transaction where we represent a practice, we remind them, find the best cultural fit. If you don't find the right cultural fit, you're doing a disservice to everybody. So we put together about a year ago, and this is for reference, I'm not going to go through the whole thing. This could be not just for private equity, but for internal buy-ins and buyouts, or if you're selling to a hospital. Where I want to get to is these are the questions that need to be asked, whether you're interested in buying into a practice or selling your practice to someone else or what have you. So we put these questions together to give you something to start with, right? And so these questions are designed to help you determine whether or not whatever option is a good fit. And if you're an employed physician and you're thinking about buying into the practice, all of these questions are fair game. Because when you buy into a practice, you are assuming the liabilities of that practice, warts and all. So looking at the financials, looking at human resources, looking at how COVID relief funds were going to be handled, and that's still applicable today. How many of you took employee retention credits? You know the statute of limitation on that is 8 to 10 years. So just a little quick side note, it's not in the slide deck, but if I have a provider who's retiring, a partner who's retiring this year, and if I get audited by the IRS and it's determined I was not eligible for that employee retention credit, how are we going to handle that? Every transaction for the next 5 to 10 years needs to have a clause on how you're going to handle the government taking back COVID funds for which a soon-to-be retired partner benefited from. You need to think through those things, because I'd rather have the conversation now than before the need arises. It is my personal opinion, not my professional advice, but it's my personal opinion that under the current federal administration, there's going to be less rigorous enforcement of it. But it is something to be kept in mind. How are we going to plan for those? So COVID relief funds are still a hot button topic in transactions, internal and external. I want to see a copy of the partnership agreement. I need to see that due diligence that needs to be done. And so there's a lot of things that people need to start asking questions to make sure it makes financial sense. So real quickly, how does private equity, how do they deliver profit? They're going to acquire practices. They're going to do a horizontal strategy of picking up practices within a community, and then they're going to do a vertical strategy of trying to get at-risk capitated contracts or better paying contracts with the payer. And they all come with a fair amount of risk and uncertainty. But the main driver on private equity is looking at what's called your EBITDA, earning before interest, taxes, depreciation, and amortization. This is the key to the whole thing when private equity is dangling dollars in front of a practice. And the simplest view is, let's assume the example should say Chip. I used that. Let's assume Brandon and me open up an ice cream shop. We're going to take down Ben & Jerry's. Okay? We opened the ice cream shop. After the bills were paid, we took a salary of $50,000 each. There was $75,000 left over. Okay? After we paid ourselves a salary. That is essentially the EBITDA that's assigned to multiple. And that's how they're able to dangle big dollars in front of practice. They're looking at that, not our total earning, but after we set aside some dollars for our salary and for the time spent, what kind of multiple did we do? And so sometimes they'll look at several years and they look at it and it can vary. One of the biggest wild cards, and before we dig into the formula, is your vaccine inventory. How many of you have significant private vaccine inventory? Okay. Without hesitation, I'm going to say that 99.9, if not 100% of you are using what's called cash basis of accounting. Okay? And so what does that mean? That means that when your flu vaccine comes in September, you're paying your, and Sanofi sends you or GSK, the invoice is due in December. You put it on the credit card so you can get the Mickey Mouse points, and you actually pay off the credit card in January. How many of you think it's a September expense? How many of you think it's a January expense? How many of you think it's a December expense? It's a December expense. The cash should not leave the practice until January, but we put it on the book as a liability to be paid in January. So, yeah.
How does that work from a QuickBooks perspective?
Pardon?
How does that work from like a QuickBooks perspective?
Right. So I entered the invoice.
It doesn't come out of my bank until January 17th when the credit card is due.
Correct.
That is a January expense in QuickBooks from the tax year.
Nope.
No.
It is when we put it on the credit card.
And my accountant lied to me.
Yeah. Now, there are ways to shuffle, but under cash basis of accounting, when I pay it, whether by check or putting it on the credit card, that if I pay by check, then the cash leaves the bank. If I put it on the credit card, it becomes a liability to be paid. But it is an expense when I pay it. So there may be some things. I know that there are some aggressive accountants in the world, and I'm all for that. What makes financial sense. But under true cash basis of accounting, that's how you handle it. And so the reason I bring this up is because sometimes you'll look at financials and determining your calculation. I mean, those base orders, Prevnar gives you 75 days to pay. So I've got a bunch of Prevnar that came in October that's not hitting my credit card until January sometime, depending on timing. Base order, big one. They're giving more time to pay. The reason I bring this up, the biggest wrecking ball in financials are vaccines. Because not only is it a lot of money, but the timing doesn't always correlate when you pay the expense with the right time. So that's a big variable when you're looking at evaluation, as well as cash on hand. So what happens with that? So in a private equity transaction, you have your EBITDA times the multiple purchase price, and then it can be split up. So if you run the math and say, oh, that practice is worth $3 million, are you going to get a check for $3 million at closing? No, because they have what's called an equity role. A portion of that value is an ownership of the future practice. There are some other factors, but let's see, is that 310 or, yeah, all right. So there are a variety of factors that determine how much you're going to get paid at closing. And again, you need an accountant to understand the tax implications. You need a good lawyer to have a good contract to hold them accountable to their promises. Because I've seen some shady deals start to take place that I've blown up because I know those promises aren't going to come to fruition. The last bit, whether you have a third-party transaction to private equity or the hospital or an internal transaction, you need to be very clear whether or not this is an asset purchase or a stock purchase. This grid is for reference as to what constitutes an asset versus a stock sale. So let's assume for a moment that me and Dr. Hart are 50-50 partners. We have built up this equity. If it is the tax implications, whether it's classified as an asset sale or a stock sale, are significant. And that's why you need your CPA involved. But these are some of the factors to be thinking about. One of the biggest things is what they call goodwill on the book, and I'm going to sound wonky in a few minutes, but what the accountant calls goodwill, whether or not you can immediately depreciate the purchase of the other person's position within the practice. That's really the implication as to which one you're in. But this is for reference. If you're thinking about a third-party sale, there's a long tail of what's involved. Just accept the fact of the following. If you're thinking of a third party or private equity transaction, it is a financial colonoscopy without sedation. I assure you. It's not going to be fun, and it's a lot of work. So, moving on. The reality check is that a valuation method for a cardiothoracic surgeon looks very different than a pediatric because we have such high overhead rates. And so we need to be thinking about this as the needs of children change and what our recurring revenue stream looks like. Pediatric, the revenue stream is fairly stable because you have a relationship. Think about the orthopedic surgeon. They don't have a relationship with their patient. Someone blows out their knee, they go see the orthopod, and then afterward, they're done. But you have a lifelong, potentially lifelong relationship with the patient, and that's what makes it a stable revenue stream. That's why we did fairly well in COVID. Now, it was not without its headaches and discomfort, but compared to other specialties, we did well because we have lasting relationships, and businesses that have relationships tend to weather those storms a lot better. When you're thinking about the valuation, I know I said I was going to sound a little weird on this, but the idea, have you heard of goodwill? Your accountant may use it. I built this practice and my standing in the community is worth this amount of money. Am I ringing my bell? All right. If I had one of those Men in Black pens, I would be here zapping everyone and eradicating that word from your memory as you think about the value of your practice. A valuation formula is not going to have an arbitrary dollar amount for goodwill. What it's going to have is the financial result of goodwill. If you have a good reputation in the community, that means patients are coming and it's going to be reflected in the finance. That make sense? Okay. So when you're thinking about the valuation, the idea of goodwill, just put it to the side. So how do we determine the value? As a pediatrician, you wear two hats. One hat is your compensation and your work providing care for children. And the second hat is the hat of being an owner within your practice, for which you will receive compensation if you do well. When we look at the value and start off, what we're trying to do is isolate. In this example, we have a pediatrician who owns their practice. They made $210,000. What we're saying is the first 165, depending on the market, was for their work as a pediatrician. The delta of $45,000 is the benefit of owning the practice. Can everyone good with where I'm coming from on that? Because that is the entire basis of how we approach valuation. It's recognizing the benefit of being an owner in the practice. There are many valuation firms who charge significant dollars, and they look at the total compensation of the provider, of the owner, and that's not appropriate. You should be focused on the benefit of owning the practice. So we break it up into two parts, Part A and Part B. First, we're going to look at your earnings. We're going to identify the benefit of being an owner. We're going to add your assets and subtract your liabilities. We're going to give you credit for what you own and discount for what you owe, and we come up with a total valuation. So here's the scenario. We have two pediatricians. They want to retire in the next 2 years. We have two pediatricians and one wants to retire in 2 years. Dr. Johnson, the 45-year-old pediatrician, been there for 5 years. He's a young whippersnapper. Everyone loves him. He's generating revenue. He's a great person to buy the practice. We have a nurse practitioner who works full-time and part-time. So we look at this, and we did this for the two pediatricians, and they had revenue, they had expenses. This is how much they earn. This is the variance. This is the benefit of owning the practice. Add and subtract, and add the assets and subtract the liability. So let's break this down into some parts. The earnings part. This practice generated $4.5 million in revenue. We had total expenses of 4.4 reported on the profit and loss. They showed a net ordinary income of $100,000. Inside of this 4.4 million was $400,000 in partner salary, some expenses. So the owner brought in, when you add, they made $460,000 plus the $100,000 in ordinary income. So between the two partners, they made $560,000. Everyone with me on the 560 number? It's okay if you're not. I'm happy to walk because this is important to understand. The total compensation for those two partners was 560. And what we're saying is the first 165 for each partner was for their work as a pediatrician. So what is the difference between the 165 plus benefits? What's the difference between the 177 and the average of what the two partners earn? $100,000 each. It's the benefit of being an owner in that practice. We then assign a small multiple, and this is the Part A calculation for both partners, 200,000. Yes? Why do we put a multiple? Good question. The reason we put a multiple is because we're recognizing that it has some recurring value in the future. When you do this with third party like private equity, that multiple can be 5, 6, 7, 8, sometimes 10. So this is a much smaller multiple on an internal buy-in.
Is that multiple a static number? Is that malleable by region? Is it like where are we getting that multiple information?
So I'm going to rephrase the question for the people on the World Wide Web who are dialed in. So the question was, is that multiple set? And the answer is yes. It is set as part of the formula within the partnership every year. This number is not going to change, okay? Because that's part of the formula. It's influenced by your culture. And to be 100% transparent, of all of this, this is the one gut number that I bring to the table. If you're very strong in your community, it's going to be reflected in the finances. But it's very rare that I go more than 1.8. I never go above 2 for internal buy-ins and buy-out. Because remember, it's what the buyer's willing to pay. And so we're trying to be sensitive to that 30-something-year-old who, if that number is too high, you're going to scare everybody off. And the brutal reality is that for an internal buy-in or buyout, you are not going to get the full, true business value. It's heavily discounted, and that's where that discount comes from, because it is lower than you would if you sold to private equity. That's just the reality. Yes?
So what would your recommendation be on calculating that number? Would you look at how much your value has increased over a 5-year period, 10-year period, 20-year period?
All right, I'm gonna pull it out of my back pocket. Okay. Remember that rule of thumb we talked about earlier? Yeah. How does that look? Again, it's influenced by the culture. And look, I'll be the first to admit that's a gut number. But it's going to be mutually agreed upon by the partner, and that's what they're going to use. Yes?
Why is the multiple number much lower for internal buy-ins than private equity? Is that just like goodwill, like you don't want to?
No, so the question is that why is that number much lower? And it's because I'm sensitive that if we said that that number is going to compete with private equity at 6, 7, or 8, this number becomes impossible for a 35-year-old person to buy into the practice. We're recognizing that we already have limited buyers. We're going to alienate everybody if we hit the true value. That's just the trade-off. In order to remain independent, it is going to be at a discount. The second part of the valuation, we look at the assets and the liabilities, how much cash you have in the bank, your medical supply. We'll do an inventory count. We'll look at what you owe. We add this number here and that number, and we come up with 705. So this set of numbers with two partners, each partner's estimated value is about $350,000. And this is not an uncommon scenario. Some people ask about the accounts receivable, and at the expense of running a little bit over my allocated time, I'm going to dive into this. one of the biggest issues is when we're looking at the assets and liabilities, what is the value of your accounts receivable? Now, if your accounts receivable says $1 million total, I got some bad news for you. You're not going to get $1 million. Okay? It's going to be discounted. You have your gross collection rate. So years ago, Chip and I got together and said, look, how can we be on the same page here? And so this is what we did. So this particular example, we first take the gross collection rate, and then we said that gross collection rate of 55%, we're going to apply it to everything under 30 days. And for every age category, we're going to collect 5% less. Is this perfect? No. But it is a consistent formula that you can use in your valuation. And then we know it's harder to collect patient responsibility money. Guess what? The likelihood of us collecting that $8,500 from the patient 3 months out is very small versus an insurance claim that's less than 30 days old. This is extremely conservative, but I need to be in a position to be objective and say, of the $170,000, we feel comfortable you should be able to collect 79. It's probably 85, 86. But again, by having a formula, it becomes a little easier to plug and play each year as you update the value of your practice, and that's it. That's for the internal valuation and practice. As we look at this, what drove the valuation? We can see cash on hand, that $275,000 right here, represented 40% of the value. So guess what? If you take all the cash out of the bank, the valuation is going to go down by 38%. And you need to have a conversation about that. That accumulated cash is cash that you've already paid taxes on. So if I'm bringing in a new partner, you've got to talk through how are you going to work through that. And so that's where you need to think about those kind of things. So what is the impact of removing that cash? It goes from $352,000 to $215,000 if we say you're going to buy in, but we're going to flush out the cash first. Now I got an operational problem. How am I going to pay the bills and so forth? So those are the things that you're going to work through. An external or third-party valuation is a little bit more complicated. No, it's actually not, because I showed the math. Okay? So here, they're going to look at your total revenue. They're going to look at the same net income. They're going to do what is called add back, interest, because we're trying to determine EBITDA, interest before interest, taxes, depreciation, and amortization. So we're adding that back if you took some in it. In this example, we had a non-recurring expense of some sort for $20,000. And then we look at the partner's earning. They made $400,000. They had some benefit. And this is the tricky part, and I'm going to dive into it a little bit more, but put a pin in there. When you're calculating the EBITDA of what a third party is going to pay you, it is heavily dependent on what that go-forward salary is. What does that mean? What that means is, I'm assuming going forward we're going to pay the partner $200,000 a year. They have been making more, but here the way the math works is if I bump up what the go-forward salary is, it makes this number, my calculated EBITDA, smaller. And because this is smaller, what they're willing to pay or value that practice becomes smaller. So again, we can look at this. We could probably do an hour-long presentation on how do you take this from an EBITDA perspective for a third party. But the main takeaway today is this works for internal buy-ins and buyouts every day of the week. And you set that formula. This is pretty much aligned with how third parties are going to look at the scenario. And like I mentioned before, they may value the practice at $948,000. But how much cash do you actually get at close is depending on what's called the equity roll. There are other provisions that are going to be what are called earn-out and holdback for indemnity claim. Those are all negotiated. But the main takeaway is when we look at an internal valuation and an external valuation, it is not uncommon. These were based on the exact same set of numbers, And the difference between internal and external was over 70%. That may or may not have appeal. And usually that's what's driving the conversation. Because in order to get the true value and remain independent, it's very difficult to do. It is a heavy discount in exchange for keeping a practice 100% independent. It is more art than science based on the culture. We're thinking about, the culture, and I'd like to go back and watch the video and say, how many times did I say the word culture, right? That's a touchy-feely word. And here we're basing things on math, but it is so important. I can't overemphasize that enough. The culture is really what drives a large part of this valuation. The other thing is the continuation of patients. Because if you have a partner coming in, it's predicated on continuing those relationships after that person retired. The more common scenario is that you have an older partner retiring, but over the last few years, they've been getting less newborn because moms are more interested in a younger doctor who's going to be there until their child becomes a teenager. Okay? So in some scenarios, that does unfold, but not in all. But the continuation of patient volume needs to be assessed. We also need to look at our payment rates. If we think there's going to be a major realignment in our payment structure, how many of you are from Massachusetts? All right. What happened to Medicaid 2 years ago? Full capitated, right? That's a significant change. We need to think about those types of things. We need to think about the local economy. Anyone here from Washington, D.C.? Okay. How many less federal jobs are there now in the marketplace? 100,000? 100,000 times an average of $180,000 to $200,000 a year. How much money just vaporized out of the local economy? Those are the types of things you need to think about. Lake Charles, Louisiana, I'm worried about the petrochemical plant. In Houston, I'm worried about certain things. In Denver, I'm worried about the technology sector. Those are the things you need to think about when your local economy, and also thinking about your building. When's your lease coming up for renewal? Am I going to go from $24 a square foot to $37 a square foot? That's a significant change. Those are the things that you need to think about. But you're going to have to make some adjustments. You're going to need to think through some of those things as you're moving through and working through your evaluation. Chip, Alice Meyer is great at this. Tim, and I can help with this as well. Y'all have a lot of resources to think through some of those things. And also thinking about how's that person going to pay in. Are they going to pay in over time or not? If you feel like you need to get to the next time, I'm going to kind of keep going. I want to be sensitive, but I want to make sure I cover all the material. I got a little aggressive packing stuff in here, so I apologize. But what does that future compensation look like? What are those things as we're thinking about the practice? But at the end of the day, is it fair for both sides? And how do you define fair? That's going to be driven by your culture. So how much is too much to buy into the practice? So if $300,000 a lot of money to buy into a practice, if I'm going to make another $150,000 a year, I will sign up for that deal every day of the week, because then I'm banking a 50% return. The more likely scenario is I'm going to buy in for $200,000 and I'm going to make another $80,000 a year. That's nothing to sneeze at. That's what, 27, 28%? Find me a way to make that kind of return and keep your clothes on and not go to jail. Consistently. The opportunity is there, even for the internal buy-in and buy-out. Some practices have moved to a token payment. After so many years of working in the practice, you simply pay $50,000 and you're now a partner, equal split of profits and liabilities. And when in that scenario, I'm watching a provider as they grow their practice over 5 years. I'm making money every year, and it's like, okay, they've made me around $350,000. That's when they do so it's a way for them to buy in. But they got to have some skin in the game, and there needs to be a payment. And with that token payment, it doesn't change things other than it gives them some financial stake in the opportunity. So if I have 6 providers in 2 locations, what's the right number of partners for this size practice? How many say 1, 2, 3, 4? Anyone know the answer?
Least amount possible.
There we go. Winner, winner, chicken dinner. The least number possible. So, but financially, that can be challenging and can be scary for some people. But operationally, it makes a lot more sense. And so, also the other thing is, I got a phone call from a practice in Atlanta. They were really frustrated because they were only making about $200,000 a year. And it was like 9 providers. It was a good practice, good part of town, mostly private, yada, yada, yada. They seemed to check all the bells, and then I asked them the question, how many of you are partners? They said, well, we all are. Like, that's your problem. As a pediatrician, you can only see so many patients a day. Where you go from making $200,000 a year to $250,000, $300,000, $400,000, $500,000, $600,000 a year is by having multiple employed physicians that I'm making $30,000 to $40,000 a piece off of. That is, it's not rocket science. That is the secret. So when I run into a scenario, everybody's a partner, the potential for earnings is really difficult to squeak out. So that's why there needs to be a ratio. As we wrap this up, one of the big concerns is whether or not I agree to become a partner in Dr. Allen's practice. Am I a partner from day one or not? I'm going to buy in over time, so I'm going to pay him 20% a year for the next 5 years. Does that mean I grow in, or am I a 50-50 partner from day one? Again, the culture dictates that. But what I will share with you, oh, I'm missing it. It's not here. When I go to buy a car, I'm signing 2 documents. One, a commitment to purchase the vehicle, and another one to finance it. If he's willing to take interest from me and earn interest on my investment, then I'm a 50-50 partner from day one. But if he says to me, nope, you're going to acquire 20% per year, fine. Every year we have to revalue the practice. So it comes with pluses and minuses. And then, here's the graduated scale of buying into the practice. You can say straight up, I'm not a big fan of this. If I commit to being a partner in the practice, I am an equal partner from day one. It just makes it a lot easier. And then partnership consideration. Chip mentioned this yesterday. He referenced it. Things that should be in your shareholder agreement. We will be cleaning this up on our website in the next few days. But you need to be thinking about some of these issues. And then, again, we have some resources. You need to look at your provider margin. These are on the website, as well as budgeting for your practice. That helps to anticipate what it looks like. And then I share with you, we have spreadsheets that we've made available. And I'm going to be here through the end of the day tomorrow. So if you think of anything, please let me know. And I apologize I ran over, and hope I don't keep you from your next wonderful presentation. Sound good? Thank you, guys.